Mr. Paul, definitely the governor will be addressing us soon. Okay, I think the governor is speaking. He's speaking now. Let's go live.
The committee reviewed recent developments in the global and domestic economies, assessed emerging risks to the outlook, and considered their implications for monetary policy. 11 members of the committee were in attendance. Decisions of the MPC. The committee decided as follows. 1. Retain the monetary policy rate at 26.5%. 2. Retain the standing facilities corridor around the MPR at plus 50 to minus 450 basis points. 3. Retain the cash reserve requirement, CRR, for deposit money banks at 45%, merchant banks at 16%, and non-TSA public sector deposits at 75%. The committee's decision to maintain the current policy stance followed a thorough assessment of the balance of risks. Although the headline inflation moderated marginally in June 2026, global uncertainties have heightened due mainly to the renewed hostilities in the Middle East. In view of the evolving developments, maintaining a cautious monetary policy stance remains appropriate. Considerations. In arriving at its decision, the committee noted the recent resurgence of hostilities in the Middle East, with particular attention to its spillover effects on global energy prices and the potential pass-through to domestic inflation. Notwithstanding the development, available evidence suggests that the Nigerian economy has remained largely resilient to the external shocks, reflecting the gains from prior reforms implemented by the fiscal and monetary authorities. However, maintaining the current monetary policy stance will provide an opportunity to closely monitor incoming data and assess the trajectory of inflation to guide future policy decisions. The MPC acknowledged the federal government's renewed commitment to strengthening policy coordination, with particular emphasis on the ongoing collaboration with the monetary authority, which has helped to moderate the impact of the Middle East crisis on the domestic economy. Members thus noted that greater alignment between fiscal and monetary policies would enhance policy effectiveness and support the achievement of overall macroeconomic objectives. To further strengthen macroeconomic fundamentals, the committee underscored the potential benefits of Executive Order 9. Members further commended government's renewed efforts in improving crude oil production and encouraged relevant agencies to strengthen the implementation of reforms to maximize the potential in other sectors, such as solid minerals, to complement government earnings. The MPC welcomed the positive outcome of the banking sector recapitalization exercise, noting the improvement in the resilience of the banking system as reflected in key prudential and financial soundness indicators. It nevertheless urged the bank to sustain effective surveillance to preserve financial sector soundness and mitigate potential risks to financial stability. Price and other domestic developments. Headline inflation year on year eased marginally to 15.91% in June 2026 from 15.93% in May 2026, ending the 3 consecutive months of uptick in price levels. The decline resulted from a decrease in the non-food component, which offset the increase in food inflation. Food inflation rose to 17.52% in June 2026 from 16.96% in May 2026, reflecting supply constraints in major food producing areas and elevated transportation costs. However, core inflation moderated to 15.92% in June 2026 from 16.82% in May 2026, largely on the back of exchange rate stability. Similarly, the 12-month average inflation rate sustained its decline to 17.63% in June 2026 from 18.36% in May 2026, marking the 6th month of consecutive moderation and reflecting a slower pace of price increases over the medium term. On a month-on-month basis, headline inflation declined to 1.66% in June 2026 from 1.75% in May 2026, driven by a slowdown in core inflation. Real GDP expanded by 3.89% in the first quarter of 2026, compared with 4.07% in the preceding period. This was largely driven by the resilience of the non-oil sector, which grew by 3.94%, supported by improvements in telecommunications, financial services, trade, transportation, and other services subsectors. Oil sector GDP growth rate declined to 2.57% in the first quarter of 2026 from 6.79% in the fourth quarter of 2025 due to the maintenance of oil facilities and installations. However, recent data showed improvement in economic activities as Composite Purchasing Managers Index (PMI) rose to 50.1 index points in June 2026 from 49.6 index points in May 2026. Gross external reserves rose to $52.52 billion as of July 17, 2026, from $50.47 billion as of end of May 2026, mainly as a result of receipts from crude oil-related taxes and third-party inflows. This is sufficient to finance approximately 11 months of import of goods and services, surpassing the international benchmark of 3 months cover. Global developments. Recent estimates indicate that global growth is anticipated to slow to 3% in 2026 compared to 3.5% in 2025, reflecting the impact of heightened geopolitical tensions in the Middle East, trade policy uncertainties, and tight fiscal conditions. Risks to global inflation remain on the upside, driven mainly by the increasing prices of crude oil and other commodities. Inflationary pressures are likely to be further amplified by supply chain disruptions and climate-related shocks inhibiting food production. Additionally, exchange rate volatility and fiscal constraints pose upside risk to inflation in most emerging and developing economies. Outlook. Output growth is projected to remain resilient in 2026, anchored on the recent improvement in crude oil production, expansionary Purchasing Managers' Index, and the positive impact of timely policy reforms. Inflation is projected to moderate further in the medium term on the back of continued stability in the foreign exchange market, lagged effect of previous monetary policy tightening, and improved food supply conditions as the harvest season approaches. The key risk to the outlook, however, remains the severe and prolonged escalation of the Middle East conflict. In the light of these considerations, the committee reaffirmed its commitment to preserve price and financial system stability and remains prepared to take appropriate policy measures guided by evolving macroeconomic conditions. The next meeting of the committee is scheduled for Monday, 21st and Tuesday, 22nd of September, 2026. Thank you.
Thank you, Mr. Governor, sir. That was communique number 163, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Kadusu. As usual, we take questions from members of the press. Please, when asking your question, state your name and don't forget your medium and then ask your question. One question each. Thank you.
Thank you very much. I don't know about one question, but good afternoon, Governor and members of the MPC. I'm Nancy Naji, Moneyline with Nancy on AIT. Governor, let's take it from where you ended your speech. You talked about headline inflation. It's been virtually flat, at least the last 2 months has shown us that 15.91% in June, from 15.92% in May. And we've seen inflation hover around 15 to 16% for the last 4 months. I'm wondering if that is a comfortable play too for the central bank's MPC looking at it, because I heard you clearly earlier on when you talked about you do everything possible, So I'm actually wondering, with the supply side risk we're seeing from the Strait of Hormuz situation, global energy pressures also adding to what we're having here in Nigeria, how is the CBN going to tackle headline inflation? And if you're still on the trajectory of single digits, so because inflation, that's where it hits all of us, is the thief that we are all chasing. And the side parts, congratulations for the international recognition, Central Bank of the Year. Let me just give you that, so congratulations.
Well, thank you very much, Nancy. Again, I think it's appropriate to remember where we're coming from. 11 months of disinflation, and quite frankly, from every indication, we were expecting that by early 2027, we would be where we want to be in terms of inflation and, firmly on track for single digit. Unfortunately, as you know, and you said it, these were shocks that came that, were not anticipated in that manner, and has gone on a lot longer than could have been anticipated. And really and truly, at this stage in the game, who knows how long that is going to be. So it's not something we can wish away. It's just something that we need to deal with. We are pleased, however, on 2 counts. One is the fact that inflation has moderated, albeit slightly. It has moderated. Headline has moderated. So that gives us an indication of the fact that the tools that we have implemented so far are bearing effect. They are bearing effect. Secondly, and you're absolutely right, there are rigidities, that these are all rigidities that really and truly hit you from different sides. Collaboration between the fiscal and the monetary at a time like this cannot be overemphasized. And we intend to deepen and strengthen that collaboration such that we are alive to the responsibilities. And as I said, we will do what we need to do to ensure that we can contain rising inflation in any manner and bring it to the single digit that we have said earlier, and we still continue to stand by that. On the other note, I thank you very, very much for your kind words with respect to the Central Bank Award, Central Bank's Global Award for 2026. And a couple of things I think it's important to say here. One is that if you recall, for those of you who may have followed, I was very clear in dedicating that award not to the central bank governor, but to the staff and management of the bank. I felt, and I do feel, that that was a very, very important thing to do, because I understand fully that a lot of the very, very hard work that has been done by the central bank has not been done by the governor on his own, but has been done by the whole bank. And at times like this, when these recognitions come, it is important to sit down and reflect on the road of travel and why we are being relatively more successful and recognized internationally, by the way. This is not a local recognition. And one of the things I said when we received that award is that, the responsibilities of central banks around the world are a very solemn one. They are a very solemn one. What do we mean by that? We mean that they are a very serious one. It's not something that you take lightly, because the decisions you take impact millions of people, and in our case, hundreds of millions of people. So those who are dedicated to the cause, who are working behind the scenes to ensure that the central bank is living up to its expectations, need to be recognized. The other important thing from that is the resilience of the Nigerian people. The resilience of the Nigerian people. This has been a hard and tough journey. It's not been easy by any stretch of imagination. And I know that sometimes I get asked the question that, how does that percolate? And you are one of those that have asked me that question a number of times. How does that percolate to the man on the street? Now, if you watch, you will see that one of the most fundamental shifts that has taken place over the past couple of years is the stability of our system. Now, without that stability, you don't get investment. And without that investment, you don't get the growth that we need. So, it's been so important to ensure that we work hard to get that stability in place. And that is forming the platform for the greater growth in our economy. Reserves have been up. As I said, the stability is there, and the resilience is gradually paying off. So I thought it was very important to mention that. And then finally, I think one message that certainly I have gotten from this, and I would encourage everybody else too, is the fact that we are not an island. We are not an island. We'll be making a mistake to think that the things we do are not recognized and are not monitored by the rest of the world. They are. They are. And all the very difficult and painful reforms we've made, which were eloquently spoken about during the awards ceremony, are ones that have been tracked by those who make it a point of duty to do so. And they can see that those reforms have taken us to a journey that is paying off for Nigeria, and as other things begin to cascade and join with this, I'm confident that there'll be better times ahead for the country.
Good afternoon, Mr. Governor, members of the MPC. My name is Nduka Chejin of the Nation newspaper. Mr. Governor, sir, the IMF recently said that the Naira is estimated or a bit undervalued, estimated at about 1,142 Naira to the dollar. That's what they are saying. This suggests that the currency is about 25.6% undervalued. What is the position of the central bank on this? Thank you very much.
Thank you very much. Again, to say that our view is one of continuing on the path that we had embarked on, and that is to ensure that we have a market that is transparent, that is liquid, and one that has willing buyer, willing seller. That's it. Now, where that price settles, And again, don't forget that these are the price is a moving target. It's a moving target. And where that price settles is a function of a number of different things. Where it eventually settles is one that cannot be done without fundamentals kicking in. Without fundamental kicking in. Oil and oil exports, FDIs, domestic productivity to reduce imports, all those things need to kick in. But we are very comfortable at the central bank that we have a fully functional market, a market that is open, that is transparent, a market that sometimes you find that on a daily basis, the amount of turnover is in excess of 1 billion US, and a market that is responding to the positive things that we are doing as the central bank. A very important issue at the present level, the country does need a competitive currency, and from every indication, the levels in which they are move for competitiveness. Thank you.
Good afternoon, Mr. Governor. Good afternoon, everyone. My name is Musa Abubakar with NTA. The Central Bank of Nigeria recently launched the Nigeria Overnight Financing Rate in collaboration with Financial Marketers Dealers Association to provide a kind of credible benchmark for the financial market. What does this mean for the economy, and how does it support effectiveness of monetary policy? Thank you.
Thank you. The NOFA is Nigeria's official overnight risk-free rate benchmark. It reflects between banks, it reflects the cost of overnight secured funding in the Nigerian interbank market. Now, why is that important? Why does that matter? Because really and truly, it reflects two things. One, it reflects greater transparency in how that particular rate is determined. In the past, we had a situation where banks would simply give a rate that they believed should be reflective of what interest rate should be. We've now done away with that. This system ensures that the real transactional rates, as opposed to judgmental, are the rates that are being used. That's very important. And I would also not hesitate to say that that is certainly something that has, we're not the first ones to do this. We're taking ourselves up to benchmark world standards. The UK, for example, has long moved away from LIBOR to SONIA, and so has the United States. So we are basically going into a more, we're getting in line with the international benchmarking standards. Going forward, of course, we expect that there'll be greater synergy between the MPR and NOFA going forward, and that MPR is a benchmark; it's a general benchmark rate, but the NOFA, it will give you a clearer idea of exactly at what point transactions are being executed. And indeed, going forward, as we go down that road of inflation targeting, it will be a key ingredient to plug into that inflation targeting framework.
All right, there you have it. That's the latest one. We've all been holding our breath, waiting for that. I guess maybe some of us at this point, but it's the same thing. Just like The May meeting stuck at 26.5%. Other parameters left held there, and definitely the governor did, unpack a lot of things. He did talk about the purchasing managers index there at 50.1%. That was a positive for him. Getting back into expansion from contraction, that's anything below 50 points. Then we see the forex market still stable going forward. Closed at 1,380 naira. That was the last close there. Was up about 1 basis point. That's for yesterday, and the expectation is today's close won't be far from this. Then for foreign reserves, we're at 51.8 billion, which is approximated to about 52 billion. That's for the gross Nigeria's foreign reserves at this time. That's our buffer, which he said has crossed the 3 months cover. That's the global benchmark at this point. So a lot of positives there, but I guess the negatives were largely the shocks from the energy market, definitely the war in Iran. And he did talk about Nigeria's GDP for Q1, 3.89%, coming from, I think, about 4% in Q4 2025. So a lot to unpack there.